Very good. So thank you very much, Chris. Appreciate that nice introduction. Welcome, everyone. I have some great stuff to share with you today. So, as Chris mentioned, I've been trading for a long, long time. My dad got me started, and he started me trading when I was 8. Yeah, well, I couldn't do it legally, so he just taught me trading. But then he would actually go and play some of the trades, and we would watch them. So yeah, I'm 55 now and started when I was 8. So 47 years of trading experience is pretty good when you're only 55. Only 55. Yeah, I like saying that. But anyway, so the nice thing about that is in that kind of period of time you see a lot of things happen in the market. I've seen a lot of changes in technology and you also see a lot of dramatic things happen in the market that newer traders might think are unique and unusual, but when you've been around for 4 decades, you've seen it before, and you realize that these things are chaos. Even chaos is part of the system of nature, and so you learn to prepare for it and to be very risk adverse and very protective and hedging positions and so forth. So anyway, today what I'm going to share with you is over all those years I've learned and been exposed to many, many, many different types of trading methodologies. And I have a lot of friends in the trading community, and some of them have very different trading methods than mine, and they make money with them. So I'm not here to tell you that there's only one way to make money. There certainly is not. In fact, I'll tell you the exact opposite. There's many different trading methodologies that are valid and that I have friends who are making money with. But for me and for my personality, and this is a big part of it, is not only do you have to find a trading method that is statistically significant, meaning putting the odds on your side over a large sample of data, but you also have to find one that fits your psychological profile, one that you are comfortable with. So I'm going to share with you mine today, and it's up to you to decide whether it makes sense to your brain cells or not. I'm not selling anything today, so you can put your wallets and your purses away. I am, however, going to give you a free course, a free 5-day video correspondence course. And the way I work that is each day you get a new video. They're rather short videos, so you can consume them very quickly. But they're about some things that are a little unusual, a little heterodox, a little bit against the traditional technical analysis, and things that amateurs typically get wrong. They think they know, like head and shoulders patterns, things like that everyone thinks they understand. And I show you how professionals trade them as opposed to amateurs. Some of the finer points, and those finer points are the difference between making money and losing money. And each day is something different. So one day it's head and shoulders, the next day it's something else. And then at the end of each of those videos, there's an interactive quiz so that you can make sure that you got the information. On day 4, I'm also giving away, and I used to only sell this, so you're getting something that I used to only sell, and that is one of my favorite trade setups. I call it the rubber band trade, and I'm just going to give that to you on day 4. You get all the details of the setup, the filters, everything. It's actually a very simple trade, but it's a great one. In fact, to this day, every time it sets up, I still take it every single time because it's such a fantastic win-loss ratio. I'm not going to go into my history, even though it's listed there. Chris already did that, and because I want to make sure I get on time, or get done on time here, I'm not going to spend time asking you guys questions. I know you just want to get to the information I have to present, so let's move on to that. So what do I do? How do I trade the markets? Well, my approach to trading is all about one thing, and that is defining what I call the energy in the charts. The energy in the charts. And I like this approach because it's very objective. It's completely rule-based. There's really no room for discretion or objective feeling. Everything is defined very clearly with objective energy. So what's going on in the market right now, not what people say or what they're talking about or how they feel or what they think should be happening. None of that stuff really matters. In the bottom, when we get to brass tacks, where the rubber hits the road, the bottom line is, what are people actually doing? Where are they committing their money? And where they commit their money is not what they talk about, it's the orders that they place. It's not even the bid and ask. because, you know, I've got a friend, for example, he games the market. So level 2, the old SOES, the SOS Bandit stuff, just really outdated, outmoded, because people play with those bids and asks to try to move the market. So I want to see where people have actually placed their money. Again, put their money where their mouth is. So here's how I define the energy. What do I mean by energies? Okay, there are 5 energies that I look for every single time that I'm considering taking a trade. All right, so first of all, let's just start out. I encourage you to have a pen and paper handy and go ahead and just write this down. These are the 5 energies that I look for in every single trade. Number 1 is trend. And trend simply refers to the direction of the market, up or down, okay, or sideways. Energy number 2, and by the way, as I said, I'm very methodical in my trading. So I look at the same things in the same order every time. I've got a friend who has a little 4-seater plane, and he takes me up in that plane. We'll go to Catalina Island. And anyway, he's been flying for decades, but every time before he takes off, he has his little checklist. And he goes through that checklist in the same order as he prepares to take off. And I said to him, Don, you know, God, you've been doing this for 20 years. Don't you know what you're supposed to be doing and looking at before you take off? And he says, yes, I know, but this is so important that I still keep my little list here. Literally, it's written down, and I go through it every single time. Well, I do the same thing with trading. So this is my checklist when I look for a trade. Really 5 things, always in this order. Step 1, as I mentioned, what's the direction of the market, up or down? Number 2, what is the strength of that trend? This is where a lot of traders get into trouble, especially trend traders. They'll look at a chart and they'll say, oh, okay, the market looks like it's going up. First of all, that in itself is a subjective opinion. So I never look at a chart and say, well, it looks like, or I think, or it feels like. Never. If you find yourself thinking those words, then right away you know you have a subjective methodology. So I have an instrument that measures trend, just like with my friend Don. He's got his instrument panel on his plane. He's been flying so long, he pretty much can look out the window and he knows roughly how high he is, what the altitude is, how level the plane is. But it's better for him to look at the instruments because they tell him exactly what his altitude is, exactly what the angle of the plane is from head to toe and from right to left. And so the instruments are objective measurements. There's no arguing with them. They tell you precisely what the measurement is. So the same thing here. Trend is lagging. You might be in an uptrend, but the point is when you get into that trade, we don't care what the trend was when you got in. We want to know what's it going to be after you got in, or at least what the probability is. So that's where momentum helps out, because you could get into a trend that's weak. Yeah, it's moving up, but it's moving up on weakness, and therefore a weak trend tends to fail. So before I take a trend trade, I would have to ask myself question number 2 about energy number 2. What is the momentum of this trend? What is the strength? If it's a weak trend, I'm not going to trade in the direction of the trend. If it's a strong trend, then I'm looking to go ahead and do that, but not yet. Then I need to look at energy number 3. Then the third consideration is, okay, I'm interested in trading in the direction of the strong trend, but when? When do I enter? The timing aspect of it. Absolutely critical, and I find that very few traders know how to do this. This is one of the biggest challenges most traders have, is timing. Timing. I mean, a chart is a 2-dimensional object. It only has 2 things, price and time. And yet so many traders neglect time. And that means you're missing out on 50% of the information on that chart. Well, obviously, you cannot establish a probability scenario with only 50% of the information. So unless you have a really, really good time indicator or instrument, and you know how to use it effectively, you've already set yourself up to lose. All right, we've decided time we're going to get in, when we're going to get in the strong uptrend. Now, and that's support resistance. Support resistance is important because it's a blockage of the first three energies. It will stop those first three energies. So, of course, if I'm going long, I'm going to be buying off of some sort of floor or support level. If I'm going short, I want to be shorting off of some sort of resistance, a ceiling. And then the fifth and final energy that I look for in every single trade is what I call the fractal energy. And more accurately, it's the scale. And in trading terms, we refer to this as using multiple time frames. So if I have been, let's say I'm using a 5-minute chart for my trading, all right, then I would look at a 15-minute chart. And that 15-minute chart would be my, what I call fractal energy, the next higher time frame. And I call that my confirmation chart or my filter chart. It either confirms for me to take the trade setup on the shorter term time frame, or if it doesn't confirm, it filters me out of taking an otherwise good-looking trade on the short-term time frame. And that's it. That's all I'm looking for, is those 5 energies. Now, as I said, I need some instruments, objective instruments, to measure this for me. So real briefly, for trends, I use a moving average. For momentum, of course, momentum indicator. For cycles, I use an oscillator. For support resistance, I use previous cycle highs and lows, previous wave highs and lows, floor trader pivots in Fibonacci levels. And for the fractal energy, the next higher time frame, I use a 3-to-1 ratio. So as I said, if I'm trading a 5-minute chart, looking for my setups there, then my next higher time frame, my fractal chart, would be a 15-minute chart. On the E-minis, if I'm trading the E-minis, I'll often use a 1,000-tick chart for my setups, and then a 3,000-tick chart for my confirmation. So 3-to-1 ratio. Now, the reason for doing all of this is one thing. I'm looking to determine a probability scenario. In trading, there's no certainties. No certainties. My dad taught me, and this is a common saying among traders anyway. He didn't make it up, I don't think, because I've heard others say it too. But here's the saying. The saying is this: the market can do anything at any time. In fact, I often encourage students to make a little poster of that, or even just put it on a Post-it note and attach it to your monitor where you're trading, just to keep that always in the front of your mind. The market can do anything at any time. And boy, believe me, that is true. So never get too cocky or confident in your trading, because just by about the time you do, the market's going to throw you a zinger. I've seen it so many times. So this is why professional traders put their focus on managing risk. And the winners take care of themselves with our methodology, you know, and our rules. Great, we'll stay in that winner as long as we can. But we always make sure that we've got our risk managed, because, and just, you know, some examples of we've experienced here within the last few years even, of the market could do anything at any time. Fat finger trades. Right? Somebody puts in the wrong size. Instead of 1 million shares, they put in 1 billion shares. Wow. Oopsie, little problem there. Yeah, that can cause. I mean, there's technology things that try to pick these things up now, but we have seen where that has caused some dramatic spikes in the market, and that can wreak havoc. News, dramatic economic news from overseas, or a terrorist attack, or war breaking out. My goodness, you know, all of these cataclysmic events can happen at any time without any warning, and they could be technology errors, or they could be economic news, or they could be political. It just runs the gamut. I've seen it all. It's crazy. So all of that is to say that it's very important to understand that all we're doing is managing probabilities. And a lot of people will acknowledge that verbally, but they don't trade like it. And I know they don't trade like it, and they don't have the mindset of it, because they'll send me questions saying, well, how do I know what the market's going to do tomorrow? Or, you know, the other day at a seminar, I was was giving to like a few hundred people there, and someone stood up and said, "So where's oil going to be in a year and a half from now?" Well, a lot can happen economically and internationally a year and a half from now, and with technology and energy, all of that, energy, technology, those, oh my gosh, who knows? Who knows? God only knows, and he's not talking. So, whenever people use terms like "how do I know," or "how do you know when," or "know whether," anytime you use the word know, K-N-O-W, right away you know your mindset is in the wrong place for trading. So really, we just have to always, always, always be thinking about probabilities. And that puts us in the right mindset because it helps us to understand that we don't know anything, and therefore we have to always be managing our risk. So how do we establish a probability scenario? How do we make trading different from gambling? In other words, gambling, you go to a casino and you go to the slot machines, and those slot machines are programmed against you, right? They favor the house. The odds are in the favor of the house, so they're going to make money, and that builds huge, glamorous casinos. That money does. So in trading, you can make a lot of money too. It's possible. Most don't, by the way. The vast majority of people lose money trading, but there's a very, very small percentage of people who make a lot of money, and then there's some medium winners too. So the big question is now, how do we determine a probability scenario that favors us, that puts the odds on your side? Well, here's how I do it. At each potential entry point, I ask myself one simple question. How many of those 5 energies are aligned, all saying buy or all saying sell at the same time? That's all I ask. Now, when I answer that question, I give the setup a score of 1 to 5, depending on how many of those energies are aligned. Obviously, the higher the score, the higher I consider the probability of success. I liken this to taking each trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. See, again, this is probability talk, not certainty talk. So important to get your mind into that state of probabilities and not certainties. So the key here, though, is we've got these 5 energies that we're using with 5 instruments measured by 5 objective instruments, and we're adding up how many say buy or sell, if that's the case, and the more the better, right? Now, here's the key, though. Point number 5 on this slide. If I was using 5 trend indicators, that would not work because they're all measuring the same energy. The operative word in that last sentence is we need 5 independent witnesses. Independent. And what I mean by that is these 5 energies, trend, number 1, is not correlated in any way to energy number 2, momentum. And momentum is not correlated to energy number 3, cycles. And cycles are not correlated to support resistance. And support resistance is not correlated to the fractal energy. So each one of these is independent and uncorrelated to the other 4. And that's exactly what makes it significant when all 5 agree and say buy. Because they're measuring different, very different things. I mean, price trend, let's say price trend's going up, okay, quick example. Momentum might also be going up, and that's great, then they're aligned. But that's just 2 out of 5. That still doesn't give us a probability scenario. Sometimes price trend is going up and momentum will just be flatlining, going sideways. Other times price trend is going up and momentum is actually going down in the complete opposite direction. Even though momentum's down, price is still going up. How can that be? Because they're measuring different things. And that's very important because that's the only way that makes it significant when all 5 align. Now, let's talk about that. How much do we need? What gives us good enough odds? 3? If 3 out of the 5 energies align, does that put the odds on our side? Answer is no. You might think so, 3 out of 5. Well, that's better than 50-50, right? No, it's not better than 50-50. Why? Because trading is, you sometimes hear people say, well, trading is a net loss, or it's a zero loss game, right? Net zero. That's wrong. Every time you enter a trade, you are automatically losing money. It's not a zero-sum game at all. It's a net loss business. So every time you enter a trade, you've automatically established a losing position. That's because you have your overhead costs, your static overhead costs, fixed costs, as they're often called. You have your spreads, which are sometimes surprising. You have your commissions. You have your exchange fees. Okay, so you get the idea. So you've got these costs that are built into every single trade. So 3 out of 5 is not good enough because these costs offset it and bring it too close back to 50-50. Now, therefore, I say in my methodology, my rule is you need at least 4 of the 5 energies to align, saying buy or sell. And obviously, if you get 5 out of 5, well, that's even better, of course. Okay, now let's go through these 5 energies again. I see some people are asking for me to repeat those 5 energies. I have been going a little fast here just because this is normally an hour presentation, and I'm squeezing it into 45 minutes. So, but I will go through these energies again right now, and I will give you visuals of them. So energy number 1 is trend. For trend, I use the 50-period simple moving average. That's the red line here. The angle of that 50-period simple moving average is the direction of the trend. Now, again, here's a place where I disagree with classic technical analysis. Classic or orthodox technical analysis defines trend as an uptrend would be a higher high and a higher low. A downtrend would be a lower high and a lower low. No, that's wrong. That's wrong. Why do I say so definitively that's wrong? Because when we define a word, we go to a dictionary, and that gives us the definition of words. And the dictionary definition of trend is this: to extend in a general direction. So if you think about that, the operative words there are extend and general. So to extend in a general direction means a long-term move. So trend refers to a long-term move. Here in this blue ellipse, we have a higher low and a higher high. So is the euro in an uptrend? No, that's not the extended general direction of the market. So I use a 50-period simple moving average for 2 reasons. Number 1, it's well documented, and it's used by many, many, many people. So that and the 200 simple moving average are the 2 most commonly used moving averages. That creates a bit of a self-fulfilling prophecy because masses, people look at them, and professional traders look at them as well. And number 2, it is a longer-term measurement, 50 periods, 50 bars. And so that's why we don't want to use, some people say, oh, you should use a shorter-term moving average because it follows price more closely. I don't want it to follow price closely. I can see what price is doing. I want indicators that show me something different than price. Otherwise, I don't need them. So for example here, you might even have someone who says, oh, look, we've got a reverse head and shoulders. There's your left shoulder, there's your head, there's your right shoulder. Wrong. That is not the reverse head and shoulders pattern. But a lot of amateurs will think it is. And so this is great because I fade their trade. I know the direction I'm supposed to be trading is down. 50 MA is down. So therefore, I will short here, I will short here against the amateurs. And they wonder why their trades don't work out. It's because they don't know what they're doing, quite frankly. And that's not to be insulting. That's just a statement of fact. They haven't taken the time. See, professional traders understand that trading is a profession. And it's not get rich quick overnight. So they put a lot of time into it, and they learn the nuances. The amateurs miss out on the nuances, and the nuances are where the money is. So yeah, we are taking the opposite side of the amateurs' trades. It's not intentionally to hurt them. There's nothing personal about it. It's just that we're trading correctly, and they're not. That's all. So the direction is down, and so that's what we're going to do. And we know that's not a reverse head and shoulders there. In my 5-day video course, I explain why that is. Now, let's go to energy number 2, momentum. All right, here's our 50 MA. Trend is up, higher high, higher low, higher high, higher low. 50 MA is up. How would we know we have a high probability of making money if we buy this low, but not a high probability of making money if we buy that low? Trend in both at that snapshot in time on the hard red edge of the screen right there, trend is up. Direction is up at that snapshot in time, which is what we have to trade, snapshots on the hard red edge of the screen. Okay, so here's the way we would determine the probability of buying those two lows. We have to go to energy number 2, momentum. Remember I said momentum tells you if there's a strong trend or a weak trend. Let me show you how. So this low, we go down here, look at our momentum indicator. We have had a higher high and a higher low on momentum, as well as a higher high and a higher low on price. Here's your 0 line for momentum. That means no strength one way or the other. But at this retrace, the indicator is well above the 0 line, meaning, yes, there's strength to the upside, and therefore we are encouraged to buy that low. Next, price makes a much higher high. Momentum does not make a much higher high, it makes an equal high. That's your first little signal or tip-off that there's a momentum shift. And what that momentum shift means is that the trend is weakening. There's not strength behind that movement. Yeah, it's still going up, but it's going up on weakness. Okay, then we come here, and we're considering buying this. Well, trend is still up, but see, trend is a lagging indicator. Momentum is a potentially leading indicator, and sure enough, the first leading indication was the equal high on momentum with a higher high in price. And then when it comes to our low, look, momentum actually put in a lower low and went down to 0. So that means that that low, even though direction is still up, direction is up on weakness. There's no strength. And that gives us the important answer. Can we expect with any probability that the market will continue to trend up after we enter? And the answer is the probability is no. Now, some people obviously bought because there's green bars going up, and they then get stopped out. The market turns right around, takes out that low, and we have opportunities then to actually fade the trade. So instead of going long, we'd actually say, oh, there's probably going to be people buying this because they'll think it's an uptrend, and it is, but they won't see momentum. And so we can fade here, here, or here. 3 great opportunities to go short. This is the aggressive one. This is a little less aggressive. And this one's the conservative one because we've already gotten below the 50 MA. 50 MA has already gone flat, therefore indicating the trend is over, and is also providing resistance, and momentum is now below 0. Energy 3 is cycles. Cycles are just the rhythm of the market. The market doesn't go straight up or straight down. It wiggles up and wiggles down. It's like the respiration of the market. Inhale, exhale. It does that. And so we've got a cycle indicator that gives us the lows and the highs. But for an uptrend, we're looking for the lows. Timing. When do I want to get in on this? Remember, though, we can't trade any one of these indicators. There's a lot of people who say, oh, I don't need any stinking indicators. I just trade price patterns. Well, I halfway agree with those people. I've got 2 friends who do that. And, you know, they make money. They do very well. And I've traded with them. And I know their method inside and out. And I respect them. You know, they do good. But I took their method and I applied the instruments or the indicators that I used to their method, and I did better. And the reason is, again, in order to establish a probability scenario, we need a number of variables that are unrelated to each other. And when those variables align, that's when it's meaningful. Any one of these indicators by themselves, totally useless in my opinion, completely useless. And that's what people do. They'll take an indicator and they'll back test it, auto sample forward test it, all that kind of stuff, and they'll say, it doesn't really work out that well. Absolutely, I agree with that. It does not. And here's an example. Cycle highs and cycle lows. Okay, well, there's a high, there's a low, there's a high. But look at price. The range has dropped down so much, the volatility. So I don't want to trade these highs and lows. But how do I know that? Trend is up. The cycles are there. But what I'm not showing on this chart is what? momentum. If I put momentum on this chart, it would have zeroed out here, and I would know there's no strength. And so, yeah, we're going to get a decrease of volatility. I don't trade every cycle high and low. I only trade when, what? At least 4 of the 5 energies all agree. Any one of these is completely useless. Okay, now let's look at support resistance here. So, and by the way, I see some questions coming in, and if I have time at the end, I will answer the questions. I want to just first make sure I get through the presentation before the next speaker, and I want to respect the time. So if you have any questions and I don't get to them, feel free to send me an email at barry@topdogtrading.com, and I'll even type it into the chat room here, barry@topdogtrading.com. There, it's in the chat room, not in the question box. It's in the chat box. Okay, but someone did ask me an important question here, and that is, are my indicators proprietary? And no, they're not. No, you don't have to buy any special indicators. All of my indicators are standard indicators available on pretty much any charting platform. Okay, just again to respect time for support resistance, let's look at this last arrow here. We'll just skip over to the last one. Now, how, again, support resistance. Look at this chart. Here's our Fibonacci levels. That's one type of support resistance I use. And just looking at the chart, you can see that price just slices through some of those Fibonacci levels. Others it bounces off of. So now the question is this. How do I establish a probability of which of those levels the market will just slice right through like they're not even there, and which ones it'll bounce off of, putting in highs and lows? Great question. You must answer that. Again, by itself, the Fibonacci's don't tell you that. You don't know. Not important. Useless by itself. So we add up our energies, the sum of all energies. So taking this one, we've got this blue level. What is the blue level, first of all? Well, it is this wave high, and it's also the 50 Fibonacci level. So it's a cluster. That's the first thing to notice. It's 2 resistance levels overlapping, so that makes it stronger. Why does it make it stronger? It's like 2 brick walls? No, the real reason in real life it makes it stronger is because more people see it. So some traders will just see this high. Other traders will see the 50 fib. Some will see both. But the point is, the reason clusters work is because you have more trading market participants seeing the level and therefore responding to the level. That's the real life reason clusters work. So we've got that, number one, we've got a cluster. Number two, we've got engulfing candlestick with the real bodies, not with the high and the lows, but the real bodies, which is what matters in my opinion. So that indicates the candlestick pattern high. Number three, trend is down. Even though we're above the 50 MA, the 50 MA is angling down. So therefore, again, this is going to be confusing for some people because they'll see a higher low and a higher high. And there'll be people who go along here, and they are not well educated. So in trading, again, not an insult, just a fact. They haven't picked up on enough nuances to be successful. So we know the direction is down. We're looking for shorts, not longs. Then our cycle indicators turned over to say it's time to short. At the same time, we run into a resistance level. That's really what we're looking for. We're looking for the cycle indicator to give us the timing at a support resistance level. And then finally, we're looking for strength. So as you can see, when the market moves down, we pull far below the zero line on the momentum indicator. When the market goes up, it barely gets above the zero line. So weakness going up, strength going down. Put all that together, and it gives us a good trade. And finally, the fractal energy. So the fractal energy, again, just refers to using a longer-term time frame. So here I've got a 100-tick chart for my setup chart and a 300-tick chart for my confirmation. Okay? So we're looking for reasons to enter on our setup chart. Let's look at this. So price is meandering above the 50 MA, then it meanders below the 50 MA. 50 MA is our directional indicator or trend indicator, so now we're looking for shorts. Now, the 50 MA also provides resistance, another one of our energies. Again, engulfing candlestick pattern, topping pattern, cycle high, momentum below 0. So on this chart, we've got 4 energies all saying go short. However, I should say this too. Even though we only need 4 out of 5 energies, one of them must be the fractal energy. We always, always, always need the fractal energy on our side to take the trade. Now, here's where I do things a little differently again. One of the standard ways of using multiple time frames is to say only trade in the direction of the trend of the longer time frame. Okay, again, I completely disagree with that orthodox approach. Here's why. See, whenever I disagree with orthodoxy, I'll always give you the reasoning or the rationale, and then, well, you can decide for yourself if that makes sense to you or not. So here's the reason. Number one, we've already shown how trend is a lagging indicator. So that's number one. Number two is we're using an interval on the confirmation chart that's 3 times slower than our setup chart. 100 tick here, 300 tick chart here. So there's only 1 bar here for every 3 bars over here. And that's a bad combination, to use a chart that's 3 times slower and then look to a lagging indicator on that slower chart, such as trend, to confirm your trade. That just makes these 2 charts too loosely correlated. It's like my first car. Okay, my first car I got was kind of a junker, and it's all I could afford. But I could turn that steering wheel maybe 5 or 10 degrees to the right or left, and the car would not turn at all. It had that play. They call it having play in the steering wheel. Well, that's what you have here. If you use trend on the little 3 times longer interval chart, there's a lot of play between these 2 charts. And we don't want that. We want to tighten it up so that when something happens on one chart, it actually causes something on the other chart. It's not meaningless. So the way we tighten it up, obviously we want to use the longer time frame, but we tighten it up by, instead of using the trend indicator to confirm, we use the momentum indicator to confirm. Because remember, momentum is a potentially leading indicator. So that's how it correlates these 2 charts more tightly together. So I don't care what trend's doing on the longer term time frame, but I will only take a trade in the direction of momentum on the longer time frame. And I also like to make sure cycle's going in that same direction as well. Okay, so my time's almost up, so let's just finish up here, do a little summary. High probability trading, everything works sometimes. Nothing works all the time. With your money on the line, you want to know, is there a high probability it will work this time? Meaning, anytime you're taking a trade. That's what it's all about. The way that we do that is we wait for the alignment of the 5 energies to put the odds on your side. And here it is. You might want to write this sentence down. This is my whole methodology in 1 sentence. It's pretty good. I did a seminar a while back. They flew me out. You know what? I won't even say where it is. It's one of the biggest trading clubs in America. And it's a great club, by the way, really good. So I have nothing bad to say about it, but one of the members of the club, he showed me his trading method, and he wasn't done with it yet, but he was up to 200 pages of rules. I thought, wow. 200 pages of rules, okay? My rules are basically 1 sentence. Or at least this is how we summarize the methodology. And I always do it in this order. Number 1, I look at a chart and I ask, what's the trend? Up, down, or sideways? Okay, so I decide what direction I want to trade. Number 2, energy number 2, momentum. Is it a strong trend or a weak trend? That helps me determine whether I want to trade in the direction of the trend or fade the trend, or maybe just let that one pass. If it's a strong trend, then I go to step number 3. Okay, when do I want to enter this trade? Then number 4, looking for support or resistance to bounce off of back in the direction of the trend. I'm trading retraces. And then finally, energy number 5, I'm looking for confirmation by the next higher time frame. Not trend, but momentum on the next higher time frame. That's what I'm looking for. Here's a quick example of putting it all together. This will be the last chart. So trend is down, boom, 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 boom. Price pops back up above the 50 MA and retraces for the first time. So let's just count our energies. I'll take you right through it. So trend is on our side, yes, 1, early in a new trend. 2, strong trend or weak trend. Momentum's above the 0 line, strong trend. We've got a score of 2. Okay, number 3, cycle. Yep, cycle indicator comes up and then boom, pops back up. So timing, okay, we got 3 energy, score of 3. Are we bouncing off support back in the direction of the trend? Yep, that red line is our 50 Fibonacci level, so we've got a floor to bounce off of. We've got a score of 4. And finally, number 5, we go to our next higher time frame. Trend is down. Does that keep us out of the trade? No, because momentum is up and cycle is up. Therefore, it confirms the trade. We have a 5 out of 5. The method's very robust. I use the same method for trading stocks, commodities, options, currencies, and futures. I use it for investing, swing trading, and day trading, because all we're doing is putting instruments on the chart, and then whatever market or whatever time frame you put on there, it's measuring the energies of those markets and those time frames. It's actually a very simple method, as you can see. It's very objective. We're pretty much counting to 5. So, as I promised today, nothing to sell, just giving away my free 5-day video correspondence course. 5 days of videos, interactive quizzes at the end of each video. I'm giving away one of my favorite trade setups. That's on day 4 of the 5 days, called the Rubber Band Trade. And you can get that at topdogtrading.com/free.html. And my email's there too if you want to write me, and if you have any questions. Since we're out of time, we don't have time for questions today. I'm sorry about that, but I will be happy to answer any questions via email. But I encourage you to get the 5 videos, because that will give you a lot of things that are a little different than what you've heard before. Just as you've heard me say where I disagree with orthodoxy, there's a lot more of that stuff in these 5 videos. So thank you all very much. Appreciate it. You guys have been great, and I'll have 4 more great speakers coming up, so listen attentively. This is a great gift that we're getting today, and I'm excited about it. So thank you, everybody, and happy trades.
Thank you very much, Barry, and I just wanted to congratulate you and thank you for joining us once again in this webinar. And to everyone that didn't get the link, I did post it to everyone. It was www.topdogtrading.com/free.html. And just want to thank once again Dr. Barry Burns for joining us again today.